All right, so we've talked about the kinds of revenues that we might recognize, right? Imposed, derived, government mandated, and voluntary non-exchange. So the thing with revenue is, when do we recognize it? And under modified accrual, there's different ways of doing this depending on what kind of transaction it is. So let's talk about those. So on the imposed non-exchange revenue, so imposed means imposed by the government on whoever they're collecting it from. So the imposed non-exchange, that's the taxes and the fees, right? So you would record this as a receivable, right? So as the government, you say, okay, so imagine Clayburgh County property taxes. So Clayburgh County sends out property tax notices, and they say, okay, you guys all going to pay this much. Now, they haven't collected any of it yet, but they think they're going to get, I don't know, let's say $50 million. Okay, so when they levy the taxes, we do this, right? Taxes receivable, estimated uncollectible taxes, and revenues control. That's you just call that revenues account, right? So then your debits equal your credit, so it does look like you're going to get this revenue. And you put it down as receivable and revenues. If there's some that you think is going to take longer to collect than 60 days, right, then you recognize it like this. Revenues control as a debit and deferred inflows as a credit, and then when they actually do come in, you can flip that transaction. All right, derived tax revenues. So how do you recognize derived tax? So these are like your sales taxes or income tax. We don't have that in Texas, but we do have federal income tax. But some are actually some cities that have income taxes. Isn't that awful? Excise tax, which would be like tax you pay on like per gallon of gasoline. That's an excise tax. Based on a unit. So sales, income, excise tax. How do you do those? Well, there's two things going on. Sometimes you're collecting it right away, and you put that down. But sometimes you're not going to collect it till after you can use it, right? Because revenue needs to be used to settle current liabilities. That's how we match. Because that's how we match in governmental accounting, is that the revenue goes with the current liabilities. However, sometimes you're not going to get it till the next period, right? Especially the sales tax, I believe people pay quarterly. So here's how it goes. So when they're actually withholdings like income tax, and it's withheld, and it comes to you, it's like, oh, here it is, cash revenues, right? But sometimes you're not going to get it, and then you put it down as a receivable, right? Like 3 months from now, we're going to get it. So when you know how much you're going to get, you put it down as a receivable. The part that's going to come into you that you can use for the current portion of your liabilities, right, it's going to come in before December 31st, let's say. That's your revenues. And if some of it's going to come next year and you can't use it for your current liabilities, that's what we call our deferred revenues. That's all. It's like deferred. We're going to get them. We're just going to get them later. That's what deferred revenues are, right? That were deferred later. So that's how you journalize derived tax. All right. Now, government mandated non-exchange transactions. All right. So we're Texas A&M Kingsville. And let's say the state of Texas requires us to give all valedictorians a $5,000 scholarship. So if a valedictorian comes to our school, we're going to give them a $5,000 scholarship. Okay, the government has mandated that on us. All right, we don't have any choice. We have to do it. So a mandate. Here's an example. State requires schools to mainstream students and provide funds. So the special ed students are going to go to the regular high school. And then there's voluntary non-exchange transactions. So those are donations and governments. Right? So those are donations and grants given to the government. Right? So there's something you're supposed to do, and then we voluntarily agree to participate. So we weren't mandated to mainstream the students, but we got a grant to provide school lunches. Something like that. So how do you do that? Well, you're getting reimbursed after the fact. So they both work the same way, whether it's a mandated or a voluntary, right? So what you do is you don't get to recognize that revenue for it until you make that expenditure. So you're going to write that down as expenditure. So I spent some money to do some school lunches, and I'm going to pay for those lunches later. Expenditures and accounts payable, or cash, right? Expenditures, cash payable. So then that's when I put down my due from grantor and revenues. That's what I recognize my revenue because I spent the money. So before I made the expenditure, I didn't necessarily pay cash. So before I paid for those school lunches, there was nothing on the books. Paid for the school lunches, or didn't pay for them but bought them, and I owe for them, account payable. Then I put that down. All right. Advance receipts get deferred. So sometimes they pay me up front for the school lunches. Or the grant people give me the grant up front, whatever. So I got some cash in, and it's a deferred revenue. I don't get to recognize the revenue. I recognize the revenue later. It's not revenue, it's deferred revenue because I haven't done the thing I have to do. Then I provide the school lunch, or mainstream the students, or give the $5,000 to the valedictorian, whatever. So I have that expenditure, and then I have either an accounts payable or paid cash. And so now I take that revenue, right, and I get to put down my grant and then credit my revenue. All right, so that's what I do. So I get the cash in, it's a deferred revenue. I make the expenditure, it becomes a revenue. Okay. And as I said, we have to record the budget, which I know looks strange, but when you're budgeting, the revenues are expected or estimated, and they go down as debits. Estimated revenues are debits. The appropriations go down as credits, which by the time we flip through all our transactions, they'll end up as expenditure is a liability, as a credit, as a debit, and revenues as a credit. So it'll work out okay in the end. Sometimes you have to change. We get less revenue than we thought, or more, something happens, we have to spend more. Some price goes up or something. So you are going to add to your budgetary fund balance, your appropriations, your revenues. At the end of the year, the fiscal year, you will have as part of the report the original and final adjusted balance. Typically they'll show the differences, what we'd call a budget variance, but it's not required under CASB. And that actual column will be out there, and we'll look at some of those in the examples I've given you later. But there is a budgetary comparison schedule. Why? Because people want to know how their tax money got spent, and did you do it the way you said you were going to do it. And that takes care of this chapter.